Caterpillar, ticker CAT, turned $67.59 billion of revenue into a net margin of 15%. Very few companies keep that much of what they earn. Here is how the farm and heavy construction machinery company does it. Machinery is not exactly a glamorous business, but return on equity here sits above 56%, and operating margin is over 22%. That combination is what makes the stock worth a closer look. The stock itself has more than doubled over the past year, climbing from a low near $404 to a high above $1,062, before settling around $856 now. That is a beta near 1.78 against the market, meaning this stock tends to swing harder than the S&P in both directions, and a maximum drawdown of over 26% along the way reminds us it was not a straight lineup. Revenue has been choppy rather than explosive, moving from $59 billion in 2022 up to $67 billion, dipping to $64 billion, then climbing back to today's $67.6 billion. Earnings per share tell a more interesting story, rising from $12.64 to $22.05, before pulling back to $18.81 most recently. Free cash flow follows a similar arc, peaking near $9.8 billion and settling at $7.45 billion now, still well above where it started. On the balance sheet, Caterpillar holds nearly $10 billion in cash against total debt of $43.3 billion. Debt to equity sits at 2.33, and the quick ratio is below 1 at 0.78, which means covering short-term obligations without selling inventory is not exactly comfortable. Now the valuation. A price-to-earnings ratio near 37 and a price-to-book ratio above 20 are steep by almost any measure. Compare that with Deere, trading near 35 times earnings with a price-to-book of just over 6, or Cummins at under 7 times book. Caterpillar's price-to-book is roughly 3 to 12 times higher than these peers, even though its return on equity of 57% also outpaces both of them by a wide margin. So the market is paying a premium here, and the question is whether that premium is justified by capital efficiency, or whether investors are pricing in growth that recent revenue numbers have not fully delivered yet. That tension between elite returns and a demanding price tag is exactly why this one deserves a spot on your watch list. Hit subscribe if you want more breakdowns like this one, and let us know in the comments which company we should dig into next. And as always, this video is not financial advice, so treat it as a starting point for your own research, not a final answer.